Hi, this is James Eng Full Capital. And in today's September webinar, I'm starting with this quote: "The only way to stop the bleeding is to get a cut." And this will make more sense as we get into what I'm seeing at the property level for owners and where interest rates just sit today and the impacts that, going from 0 to 550 basis points on the SOFR rate has impacted everything in this market. And so the same thing that I said probably 6 to 9 months ago, probably at the beginning of the year, survived to 2025. Hopefully this will become as famous, right? The only way to stop the bleeding is to get a cut. And the second quote that I'm going to have for this episode is, let's see if we can pull it up. If it has equity, it has to go. So if it has equity, it has to go. And so what we're seeing is the gap between buyers and sellers is getting closer and closer because the maturities, the interest rate caps, those things are impacting the seller's ability to cash flow on these deals. And they can only feed it so much and they've got to do something. And so if it has equity, it's got to go. So I'm not sure which one of those is going to catch on, but I like both of them. So I put them up here. So what are we seeing in the market right now? I would say, this is just high level, probably just the last week in terms of deals that I'm seeing, right? So you've got, price reductions, you've got auctions, you've got lender owned stuff, you got foreclosures out in Atlanta. GPs are saying, look, we've got a distressed seller, so this is a great opportunity. So the distress is definitely here. Very early innings, I would say, also for the a lot of the maturities, right? So a lot of the bridge loans that were done in 2021, some of them had 2-year loan maturities, but then a lot of, or 2-year loan terms, but then a lot of them had 3-year loan terms. So this is just the beginning of anything that was on bridge coming due. This is starting to show up. So let's jump in. So the way I structured this webinar is really past, present, future, and at the same time national. So starting wide and then going to Texas and then going to DFW. So, and then we'll get into how these deals are being put together on the financing side. So past, present, future. So Newmark put out a great piece about sort of the economy, debt markets, equity markets, and there's a lot of data in this pitch. So send me an email if you want the entire pitch. That's no problem. Just send me an email and subscribe to the YouTube channel. I think I'm almost at 6,000. So hit that subscribe button and send me an email. So definitely this is one of the challenges, is almost like good news is bad news and bad news is good news. In that if the economy keeps going well, then the Fed's just going to keep the interest rate there, right? And it's going to be harder and harder for these people to buy interest rate caps. It's going to be harder and harder to refinance out of these loans. So, we'll hit these underlined portions. So soft landing for the economy. So GDP sort of stays positive 1 to 2%, just means higher rates. And, there's going to be a lot of maturing debt. So they peg it. This is across all of commercial real estate, 626 billion over the next 2 years. Investment sales are down, 50, 60, 70%, depending on the product type. There's definitely a lot of money on the sidelines, right? But it just hasn't been deployed yet. And cost of capital debt is higher. And so definitely cap rates are moving up, right? And so that's just sort of what people are seeing over the last, let's say, 6 months to 7 months in the first half of this year. So a lot of this is showing stats from the first half of the year, right? So originations down 58% on multifamily, sort of from the peak, and then across all the other property types, similar origination, and then also you sort of flip into, all right, so what type of loans are being done and what types were done in 2021 versus 22, and then now in the first half of 23. So you can see that government agencies, so like Fannie and Freddie, are not down that much, 30%, but then a lot of the financial bank, those are down more than 50, 60, 70%. So they're saying debt funds are right around that 73% year over year. So all the guys who are doing bridge, they're pretty much gone, right, in terms of the amount that they're doing. And then, so this is the number that they thought was sort of troubling in terms of LTV perspective, they were close to 626 billion. And then this really bottom blue is really where the most multifamily sits. So you see 46 billion in 2023, and then 81. So 2024 is the big year, 81 billion coming due. And in 2025, 66. And I'm guessing that's probably front half loaded. So really the next 12, 18 months, there's going to be a lot of debt coming due on the multifamily side from the bridge space that is, 2 to 3 year maturities. All right, so sales are down. There's no doubt about that. So they're pegging at about 62% first half of last year versus first half this year. So weakest since 2013. So not much is moving on the market. Across multifamily, they have it down about 70% in terms of transaction activity year over year. And then, people keep asking, where's the cap rate? And it's hard because there's not as many transactions. So it's harder to see. But, what we're seeing is, let's say in Dallas, an A deal maybe is at a 5%, and then you're maybe going to 5.5, 575 on B, and then C deals are north of 6. There's just not as many deals trading in that C space. And so we're gonna narrow in a little bit more into Texas and DFW and see some of these deals that are actually trading right now. All right, so that's sort of what happened in the first half of the year. And let's really get into where Yardi is seeing sort of the economy going. You can see that here, the GDP is pretty much, in that low 2-3% range. And it's just bumping along. And, the inverted yield curve. So you see the yield curve up here. So last year at this time, it was basically up and to the right, which is what you want. You want sort of a premium for being further out. But right now, the front end of the curve has been pushed so far up that, whether it's the 1 month to the 2 year, you're all pretty much above 5%. And then your 10-year treasury is down at 4, right? So it's an inverted yield curve. And so people are projecting sort of a mild recession coming soon, right? So coming to a city near you. But, the inflation has definitely cooled. But the question is just, when does the Fed cut? So going back to that statement at the beginning, the bleeding will stop when there is a cut. So here is what we're talking about: CPI coming down closer to 3%. The money supply is coming down as well. But in terms of looking at the national basis, like where are people moving? The top areas are Texas and Florida, right? So DFW, Austin, San Antonio. In terms of people moving in, and then this is where the rent growth has been sitting. So 10-year average is about 4%. But right now, year over year, you're probably closer to 1.6% nationally across multifamily. You see some of the major markets like Houston. Let's see where Dallas, they put it, it's positive, but it's not screaming, right? So a lot of these markets did not really have huge rent bumps up during COVID and after COVID, and they're sort of catching up. But some of the other Sunbelt markets are right around here. You can see Austin and Phoenix and Vegas are on the negative side right now. I would say that's probably driven by supply. And so we'll get in that as well. So, in the Texas market, so as we move from national to Texas, you see DFW just absolutely crushing it on the job side, 200,000 jobs, Houston 113. So people are moving here for a reason, because their jobs are here and they keep adding jobs and companies keep moving here. It seems like there's an announcement every month of a new company moving, whether from California, New York, or Chicago down to Texas. So they keep coming, and the in-migration continues to fall into Texas and sort of the Southeast from some of these other markets. Bottom 5, I guess, in terms of in-migration. So within the U.S., California, New York, Chicago, all those places are losing to the Southeast and Texas. And then a lot of that is among sort of young adults, right? So people that are going to be in that renter category. So Austin definitely has a huge change, percentage change, but then Dallas-Fort Worth as well. One of the things that is keeping apartments full right now is just that the supply of single family homes is not really there, and prices haven't really dropped, and the interest rates they hurt multifamily, but they hurt even more a lot of the single family guys. And so to get into a mortgage, this premium has probably never been greater in terms of where your rent is to how much you have to pay for not only the mortgage, but taxes, insurance that go along with that. So huge sort of premium to be in a single family home versus an apartment. But, even IPA, which is a listing broker, they are saying, look, Austin, San Antonio are having rent cuts, and Houston and Dallas are still having positive rent growth. And it's really because of the amount of construction. And so I would say this is across the entire Metroplex, but then it's probably more concentrated in the A space in terms of concessions. I would say the B and C, I've seen occupancy be a little bit lighter, but not necessarily have full rent cuts. But if your property is not at 90%, you're probably given some concessions to get it back up to 90-95% right now. The amount of construction is huge. I mean, you see on the left-hand side, Austin, 46,000, Dallas Fort Worth, 73,000, Houston, 39,000. But that is sort of what is on the way. And so once that delivers this year, next year, people are expecting a pretty dramatic pullback. And so you just sort of got to make it through to 2025 and get to that point, because that's when the rent growth will really start popping because of the supply shutdown. All right, so we talked about this stress showing already. Some people are doing assumptions right now as well, just to make sure they have that positive leverage, right? So fixing at 3 or 4%, assuming that loan, and then buying at a 5 or 6 cap, you're getting positive leverage for, you might have 10 more years left on that loan. So a lot of deals getting done that way. So this is a new slide, and I liked it because it sort of showed what's actually closing right now in DFW and what type of financing they're doing. And so if you have a market that you're interested in, if it's a top sort of 50 market, we can sort of run this for you. I can run maybe an Excel. It won't look as pretty as this. I made this for this slide and I did it for DFW. But, if you look across the board here, majority of these deals are, so the A-class stuff is really going Fannie Freddie. You see some bridge up here. Some people are willing to take maybe a bridge by like a tighter strike, so 2% strike, and then just sort of fix their rate artificially for 3 years. So some Class A stuff is doing that, but majority Fannie Freddie, larger transactions are happening right now on these deals. I mean, we see one deal probably under 100 units. Everything else is, probably north of 200, 250 in terms of stuff that closed in July. In August, similar story. We have a smaller deal, Freddie Mac SBL, mostly Fannie Freddie in the green. We see some loan assumptions, and then maybe one non-recourse bridge loan out there. All right, so this is where, all right, so this is maturities, right, that are coming up. So this is in the next probably 3 months. These deals have got to refinance, right? So they have a refinance coming due. So if you want us to run something in terms of maturities, definitely let me know the market and we can run that as well. And because something's got to happen on these. So they're going to either have to refi or they're going to have to sell. And it's probably a cash in refi, right? So I highlighted just the debt funds one because those only had a 2-year average duration. A lot of these other ones, CMBS, bank, that really is Fannie Freddie typically on the CMBS side. So their duration is typically 7 to 10 years. So I'm guessing they're still sort of in the money. They have plenty of equity and can refi, but these debt fund loans, they're definitely going to probably add to the stress of what's happening. So this is just 2023, but then as you move up to 2024, it increases significantly, right? So, this amount, they have about 1.5 billion. It might be even more than that in terms of what needs to get refinanced just here in Dallas Fort Worth, right? So pick a market. We can definitely run that and sort of figure out what deals are coming down the pipe for you to potentially buy as a GP. And then, this is what's causing all the stress right here is SOFR and sort of the forward curve. So right now, everyone sort of has pegged 525 to 550 at the next meeting, and the next couple it's 50-50, right? the next three meetings are right at 50-50. And like people don't know. And until they signal that they are going to cut, the amount of your interest rate cap is just going to continue to be expensive. The escrows that you have to put up continue to be expensive. And so, I mean, just the ballpark, I put a $10 million loan, 2 years, 2-year strike, which is typically what you have to do. And, they cost you 6% of the loan amount. So $600,000, almost $600,000 you have to have in your account if you have a $10 million loan right now. So you're either going to have to buy a replacement and it's going to cost you that much. Or if you're doing a new deal, you're doing a bridge, you might have to buy this 3-year cap with, let's say, Fannie or Freddie. So it's going to cost you $750,000, 7% of the loan right off the bat to get your interest rate that low. And, 10-year treasury definitely scared some folks, I would say, the last week or so. Everybody was pretty happy down here at 3.5, 375. It sort of spiked up to 4, came back down. We hit a lot of refis sort of at the beginning of the year, sitting at 3.5. But then, it is very difficult to refi sort of 425 and north of there, or even 4% is probably where a lot of deals can happen, because you can probably get down to 5.5% on your interest rate, 575. But up at 425, it's just you're north of 6, and it's very hard to get deals done with positive leverage. And so everyone's hoping the 10-year treasury comes down, but no one's sure. So my recommendation for a lot of people is sort of get in position as a borrower, right? So if you have a bridge loan, if you have a floating rate loan, get your third parties done, be in position so that if it does drop, you're right there, ready to rate lock and ready to go. So you've done all your underwriting and moved all the documents over to your lender at that point. We're happy to take a look at any of the deals that you have on floating rate. We can see if they size and see where they are at, and sort of what your NOI needs to be, or what the 10-year treasury needs to be for you to hit that refi. All right. So quick background on myself. Born and raised in Houston, went to school at UT in Austin, and then been up here in DFW since 2006. I was an underwriter across all these commercial property types at GE Capital for 10 years. And then the last 8 years, since 2015, really focused in on multifamily and originated close to 1.5 billion, and then invested in a lot of properties, probably 40, 45 properties across DFW, Austin, San Antonio, and Houston. So, here is a snapshot of the markets and the main loans that people are using for multifamily, right? So you saw all these types of loans in that previous slide on what deals are closing in DFW. So we're gonna dig into each one here in a little bit more detail. So bank loans, really, this is think about going down to your local bank and figuring out what they can do for you. And this is recourse, so you are personally liable for these loans. If there is any default or shortfall, you're responsible. So your balance sheet is at risk. They are still expensive, right? So prime is typically 8.5% right now, and so they usually are right around there. And so smaller deals, I would say under 5 million, are usually working with this type of loan. They want to see some deposits, and then the benefit is that it is a quicker closing. You close in 30 to 45 days. And if a deal is distressed, then you're going to have to use this type of loan on these smaller deals. And so definitely have that in your back pocket as an option. And you typically close quicker, and it is a lower prepayment. So it might just be a step down or 1% prepayment. All right. So Freddie Mac SBL. So Freddie Mac SBL has moved with the 10-year treasury. They are focused on affordable loans or affordable properties. So if your rents are affordable, it doesn't have to have affordability program, but they just look at sort of your median income in the area and see how does that compare to your rents. Rates are definitely pushing up close to 7 in today's market, but people are still doing these loans, and they are cheaper than bank loans right now. So and they're non-recourse. So Freddie Mac SBL, Freddie Mac conventional. If stabilized acquisitions, so more A stuff is going Freddie Mac conventional. We've seen some better sponsors get closer to that 35-year AM, which helps your sizing, but they're sticking to their 125, so debt service coverage, which has really protected Fannie and Freddie in terms of the amount of distress that they're having to see right now. And then on Fannie Mae, we just closed this loan. is a 10-year term, full term IO. And, a lot of, we were able to sort of lock the rate before the run up. So that helped. And then, most of these deals are going around 60% levered right now, in comparison to, maybe in the heyday in 2015, 16, 17, you get 75, 80% Fannie Mae. At today's rates, today's cap rates, you're probably close to that 60, 65% on leverage on these deals. And these are closing in about 60 days. And then non-recourse bridge, this is for those distressed deals that really need heavier lifts, right? So value add deals, 10, 15,000 a door, distressed situations, 75% occupied, can't qualify for agencies. You're going to be, we've seen some sort of, as the deals get bigger, the spread comes down. So, I would peg most deals are going to be at that 3.5% to 4%. And then you buy maybe a 1 or 2% strike. So you're looking at 6% of the loan amount for a 2-year strike, 7%, 7 to 8% of the loan amount gets you a 3-year, and sort of build that into your cost of the deal. And people are going to have to start doing these. And, some of these, I think we talked about in one of the lenders who did a lot of bridge loans, Arbor, they're expecting 2024 to be a lot of bridge loans, because people there's going to be distressed deals. The occupancy is not going to be there. And so you're going to have to move in and buy these deals with this type of leverage. So this type of leverage and this type of loan. Here's some of the closings that Old Capital's had. So we've done about 350 to 400 million so far this year. So we're on pace to probably do about half of what we did last year. We did 1.2 billion in 2022. So we'll probably hit about 600-700 million this year. And, the shift has definitely been to Fannie and Freddie. Shift has been maybe 90% acquisition to maybe 50 to 60% acquisition. And, I think we would do a lot more refis if the 10-year was down a little bit, but I think we're getting closer and closer on some of these refis and try to make them happen. Why people choose Old Capital, I would say number one is really the education piece, whether it's these webinars, whether it's speaker series, whether it's our conference. You see my Top Gun here. If you haven't registered for our conference coming up October 4th and 5th, we'll have 500 plus multifamily investors there. The podcast that we do, whether it's quoting deals, walking deals with you, really just helping you, representing you, second advice throughout the entire process. And then, even after the deal closes, right? Helping you with the loan, helping you with asset management, trying to figure out best way for you to succeed in your deal. So Old Capital Conference, here's the logo. That's been in my background. It's coming up here in about a month. And, the theme is Top Gun. So we definitely put out some nice flying videos. And if you want to see Paul and I land some of these planes, definitely come out and come out to the conference and register at oldcapitalconference.com. And then, in terms of next steps, definitely subscribe to the channel, like and comment on this video if you found it helpful. And then if you need help with a term sheet, just send me T12 rent roll OM whisper price and we'll get it sized up. And if you're looking at a deal, there's been a lot of deals actually starting to come out, and I'm happy to take a look at it and give you my comments and thoughts. And if you're just getting started really on the qualification side, complete your personal financial statement and set up time to talk. And then if you're interested in joining Old Capital, I think the next 12 to 18 months, there's going to be a huge run in terms of number of deals compared to the last 12 months. And so, get educated now. And if this is something that you want to do, definitely reach out, send me your resume, and we can chat from there. So appreciate everyone joining, and I'll see you next month.